When we talk about funds or investment companies, it sounds straightforward, but the definition is more nuanced than most people realize. Let's break it down. Under GAAP, it's not enough to call yourself a fund. You need to meet certain tests: raising money from investors, providing investment management services, and operating only to generate returns from appreciation or investment income. If you're running a business that earns profits from operations, you're not an investment company under the rules. In practice, most funds share a few traits: multiple investments, multiple investors, outside participants, and fair value reporting. Miss one of these and you might still qualify, but the more boxes you tick, the clearer the case. So how does this play out in real life? Let's walk through the common fund structures you'll see in practice, and the key differences in how they raise and use capital. Private equity funds buy and reshape established businesses, aiming to sell at a gain. Their structure is commitment-based. Investors pledge capital up front, and the fund calls it over time. That's why cash flow planning is such a big part of PE accounting. Venture capital funds work the same way structurally, but the focus is early-stage startups. Investors commit capital. The fund calls it as opportunities arise. The difference? The risk is higher, and so are the potential rewards. Real estate funds often mirror PE in structure, commitments, and capital calls, but instead of companies, they're investing in buildings, developments, and properties. Accounting here has unique wrinkles because of asset valuation and long holding periods. Hedge funds are different from PE, VC, or real estate funds because they don't use capital commitments and calls. Instead, investors subscribe capital directly into the fund, and they can often add more capital through additional subscriptions, or redeem later, subject to lockups and redemption terms. This open structure makes liquidity management a critical accounting challenge. Mutual funds, or open-end funds, are designed for daily liquidity. Shares are issued and redeemed at NAV, so the accounting challenge is the need to calculate and publish NAV every day while managing investor flows in real time. Beyond these headline categories, there are specialized vehicles like business development companies, unit investment trusts, offshore funds, and collective trusts. Each has its own quirks, but they all fit under the broader investment company umbrella. The first investment trust was formed in England in 1868 to give smaller investors access to diversification. The U.S. saw its first mutual fund in 1924. Since then, funds have grown more complex. Money markets in the 70s, global funds in the 80s, derivatives in the 90s, and today, even crypto and digital assets. With every innovation, the accounting has had to evolve too. Each fund type poses different accounting challenges. Private equity is about commitments, calls, and waterfalls. Mutual funds demand daily NAVs. Hedge funds bring valuation and complex instruments. That's why having a consistent framework isn't optional. It's essential. This page is here to make those frameworks clear. Follow the fund accounting framework for practical breakdowns, templates, and tools to simplify the complexity of investment funds.